Welcome to Module 5, Investing. Investing can be a complex activity. So let's explore the basics of investing and how they can work for you. So the three factors that need to be considered while investing are return, risk, and liquidity. Now, return is a profit that an investor makes on an investment. It can be in two forms, income or capital gain. While risk in investing is the uncertainty of achieving high returns or facing losses. Now, risk and return both go hand in hand, which means that to get higher return on your investments, you will be exposed to more risk. While liquidity is the ability to cash in or sell an investment quickly at or near the current market price. Next, let's see what inflation is and how it impacts your investment decision. Inflation refers to the rise in prices of goods and services. Over time, as the price of goods and services increases, the ability of a unit of money, say 1 rupee, keeps declining. In other words, the purchasing power of money decreases. Now, how does inflation affect your investment decision? Well, take for example a vada pav costing 5 rupees 5 years ago, now costing 10 rupees. The increase in price isn't due to more quantity or better quality, but due to inflation impacting the prices of its ingredients. And next we have time value of money. Now, money today is more valuable than the same amount in the future. This is due to factors like earning potential, interest, and inflation. It is very essential to take this into account while making investment decisions. It's always best to put your money into a variety of investments so that even if one or two lose money, the others may gain, balancing our investments. Now, this is known as diversification. It's a way to reduce risk while you're investing. And next we have KYC or Know Your Client. Now, SEBI has prescribed KYC or Know Your Client requirements for all security market investors. SEBI has allowed the use of technological innovations which can facilitate online KYC or eKYC. Now, the use of technology would facilitate the investors to complete the KYC process without the requirement of physically visiting the office of the intermediary. Now, securities can be broadly classified into two types, equities and debts. Equity is a part of a company. It's also known as stock or share. So when you buy shares of a company, you basically own a part of it and can expect a share of the profit when the company makes profits. Now, for public or listed companies, these shares are traded on the stock exchange, which facilitates the buying and selling of stocks, thus providing a marketplace. Now, investing in equities is definitely more riskier and demands more time than other investments. And next we have debt securities. Now, debt securities are those instruments such as bond, debenture, promissory note, etc., with a fixed amount, a maturity date, and usually with a specific rate of interest. Now, these are often less riskier than equities. So when a company or a government agency decides to take out a loan, it has two options. The first is to go to a bank, and the second is to issue debt to investors in the capital market. Now, this is known as debt issue. Next, we have mutual funds. A mutual fund pools money from many investors and invests in stocks, bond, short-term money market instruments, other securities or assets, or some combination of these investments. The combined holdings the mutual fund owns are known as its portfolio. Each unit represents an investor's proportionate ownership of the fund's holdings and the income those holdings generate. When a fixed amount at a fixed interval of time is invested in a mutual fund, it is called SIP or Systematic Investment Plan. This is now becoming a trending future investment plan. And next we have equity-linked savings scheme. Now, this is a mutual fund investment scheme that allows you to save income tax. That is by allowing you to invest up to rupees 1.5 lakh in specific securities and claim it as a deduction from your taxable income. Next we have gold ETF or gold exchange traded fund. Now, this is a commodity-based mutual fund that invests in assets like gold. These exchange-traded funds perform like individual stocks and are traded similarly on the stock exchange. And next we have government securities or GSEC. Investments can also be made in government securities such as treasury bills, dated GSEC, etc. Each of these instruments have different maturity, after which repayment of the invested principal is assured. RBI's Retail Direct scheme is a one-stop solution to facilitate investment in government securities by individual investors. And lastly, we have investment in government schemes. Now, a few government schemes that you can invest in are Public Provident Fund, Post Office Savings Account or RD account. Then we have Kisan Vikas Patra, and lastly, Senior Citizen Savings Scheme. Now, these schemes are recommended for investors looking for safe and fixed returns. The interest rate for these schemes are notified on a quarterly basis by the Ministry of Finance, and the post office schemes have a sovereign guarantee on the entire amount invested. Thus, they are highly safe. And that's a wrap for Module 5, Investments.